Hello everyone, I'm Steve Savant, syndicated financial columnist and money color commentator. On today's show, Ownership and Beneficiaries, Part 5 in our series on Protecting Breadwinners, Partners, and Key Employees. Well, welcome to our fifth segment when we're talking about life insurance ownership and beneficiaries. Let's just walk through some basic ideas. Remember, the person that is the breadwinner, or maybe even in a charity where I'm the contributor, or I'm in a business relationship where I have business partners, or I'm working for a business and I'm a key employee and I really bring value to the firm because I generate income. And don't forget, the person who's running the show, I have found time and again, middle management at firms, without some of these women running the show, it would never get done. So you want to not only cover the rainmaker in a business for a key employee, you want to cover the person who's running the show. Without her admin ability, you could never really make it. Now, there could be guys or gals running the show on that. There could be male or females on revenue driving, generating for the firm. But you just want to keep in mind, do both. Remember, cover the rainmaker, cover the administration guru. You need them both to make it profitability. And if you have a charity and they really depend on you, hey, listen, you want to be able to make sure that those people go on. They're going to be maybe part of the beneficiary of your death benefit when you die. So there's ways to do that, and you may want to look at that. But when I'm looking at ownership and beneficiaries, I'm looking at policy owner, policy insured, policy payor, and the policy beneficiary. Now, when I'm talking about beneficiaries, remember, will the beneficiary, this is how they're thinking in the insurance company, will the beneficiary suffer economic loss if that person who is the insured is not around? So, in the basic things that we talk about in life, yes, if something happened to me, I'm married, our family economy runs on two incomes. If one of us wasn't there, the surviving spouse would suffer. So I want to be able to enter in, I'm the policy insured, my wife's the policy insured, I own her policy, she owns mine. Also remember, keep in mind, if you're in a community property state, things could change in that regard. We live in Arizona, we are in a community property state. So we have to think in those terms and see what's the best scenario for policy, not only the insured, which is the easier part, but who should own it. So keep in mind, policy owner, whoever owns the policy gets to run the show. So if I own the policy on my own life, I can change the beneficiary. And think about this, after divorce, many people forget to change their obligations, whether it's the will, a revocable trust, and especially in life insurance. They just forget. So many other things are occupying their minds. They're not thinking in financial terms. They're just trying to recover from a bad experience in life. So when you're looking at this, the moment things happen, a death in the family, a divorce in the family, or a new marriage, you need to adjust all your beneficiaries from your contracts. So keep in mind, this is really a big deal. All the carrier wants to do, the insurance company, is, hey, who will suffer loss? Your beneficiary, will they actually suffer loss? So they can use the term insurance justification. I'm justifying the purchase of this insurance because these beneficiaries would suffer economic loss if the policy insured wasn't around. So policy insured. Now, I don't care who pays for this, generally speaking. Neither does the company, generally speaking. There's some exceptions to the rule. I don't want to manage it in this segment. But insured, somebody's paying the premium. Many times it's the policy insured. He's paying the premium. His family and his wife or spouse are the beneficiaries. I'm just looking at who's going to pay it, who's the insured, and who's the owner. The owner runs the show. The owner can change beneficiaries. The owner can assign different ownership. The owner can use the policy's cash values. Now listen, if this is permanent insurance, I have many times we make mistakes in our thinking. Do I have to wait till 59.5 to access cash values in a permanent contract? The answer is no. So I can get to that right away. I could actually borrow money off the policy as long as the contract stays in force, and it's a TAMRA compliant contract. The actual issue phrase is non-modified endowment contract. Again, talk to your insurance professional on this. And I'll be able to borrow money. If I need it right then and there, I'd go to my insurance well before I'd ever go to my 401k. Again, also, why do I want to accumulate in permanent contracts? By the time I get to retirement, I don't want everything in a taxable qualified plan. I want some of my monies that have tax deferral. I want some of my monies that are tax exempt and or tax free. Remember, life insurance cash values that are a non-modified endowment contract, that money can come out tax-free as long as it's kept in force for the life of the policy insured. The other three areas that are tax-free are HSA accounts, home health savings accounts, reverse mortgage income, that's tax-free and it doesn't involve your Social Security. And of course, Roth IRAs, the same. So this is one area where you don't have to worry about getting to your money. You can get to your money. So power of ownership, here's the other part. The power of ownership also means if there was ever a taxable event, let's say you had cash value and you were accumulating it and you decided to terminate the contract. You just said, hey, I need the cash. I don't want to make any more payments. I don't have to worry about self-obligating myself. And you surrender the contract. If there was gain in that contract, you're going to have a phantom income event and you're going to pay ordinary income tax on whatever the gain is. Remember, to make this tax-free, it has to be kept in force for the life of the policy insured, not necessarily the policy owner. Hear the difference? So you can be the policy insured, but not the owner. But whoever owns has the beauty of infiltrating or getting to cash values at any time. It also has the ability, I could have tax-free income, and I might have a taxable event if I don't keep this in force correctly. So ownership is everything. So we've talked about the basics of beneficiary. I have to have justification. I have to also ownership, who should own it, and what are the privileges of ownership. And then I want to look at the ability of who should be the insured. Again, that's the person that we're covering, because without them, we would suffer an economic liability. Now, I want to go to the next section here and just look at a little bit of customized coverage, just to touch on it. I don't want to get too much into it. And I want to talk about kids, covering the kids. I am not trying to make money on the passing of my children. When I had the death benefit, it wasn't a lot, but it was enough to take care of anything that would happen. And by the time they became old enough, I transferred ownership to them. Now they can do anything they want with it. They went ahead and did that. They were the insured. I was the policy owner. I was the policy payor. And then I was also the beneficiary. But now they made it through the days all the way up to 25. I handed them this, and that's just my age. You can do it when they turn 18, in some states 21. I transferred, they now own it. If they want to cash it in, that's their issue. If they want to keep it online and keep saving with it, they can do it. But I like it just to protect in case something happened. If nothing happens, by the time they get into their early 20s, and especially if it's cash value life insurance, I'm just going to transfer the funds over to them and they're going to take over. So I do believe in it. I did it myself. I continue to exhort people to do it. It's a good way to keep things moving. Now, I talked about this 2 segments ago, and this says, will you still be insurable? I have clients and people that I've known that are in pretty good shape today, but haunting them in the back of their genetic code is a disposition in their family. There's some congenital issues here. And sometimes you want to look at and say, you know what, I'm pretty okay now, but I might have what my father and his brothers had. And so you might have a disposition to say, I don't need all that insurance now, but I want the privilege of buying future coverage. And will I still be insurable? And to do that, you might want to look at contracts that actually support your ability to purchase future insurance coverage without going through an exam or qualifying from it from a physiological point of view. To me, that's a huge issue. I also talked about earlier about waiver of premium. If I have periods where I cannot make the premium payment, I want to know the definition of what waiver is. Does it do unemployment? Is it do when I'm sick? I want it to be able to take care of my policy, and you could add that on. Now, it adds cost. I don't think there's any free waiver premium that I can think of. You'll want to pay a little bit more, but some people like the ability to say, my death benefit, especially if it's cash value, my death benefit and my cash values are going to be paid if something happens to me and I can't make it. Again, everybody's definition of waiver of premium, or the insurance company picks it up, it's all different. You want to look at the contract. Again, talk to your insurance professional, make sure they know what they're talking about, and walk through it. You always want to look at these numbers and calculate, is it worthwhile to add anything onto the policy? Earlier, we talked about adding living benefits onto it. Some of those benefits are already embedded in the policy. There are no extra costs. But remember, somehow, some way in that policy, they're paying for it somewhere, and maybe even in the cost of insurance. So keep in mind, if you're buying a life insurance with living benefits, just keep in the back of your head, does it cost anything to have these extra benefits like accelerated death benefit rider? If something happened to me terminally, I could get some of my death benefit today because my timeline is 18 months or less. So you can start to look at critical illness. You can start to look at long-term care. Some of these contracts cover these things, and these are just customizing your coverage for your specific issue. If I had history issues and certain diseases and maladies, I'd be looking at the power to buy insurance into the future. To me, that's smart math, and that's really good defensive planning. I want to thank you for watching our series on protecting breadwinners, partners, and key employees. And keep in mind, before moving forward with any of the ideas on our show, always check with your tax consultant, legal counsel, or financial advisor. You've been watching Steve Savant's Money, the name of the game.